Hi, everyone. We're going to go ahead and get started. It's 2, and I want to just be respectful of everyone's time. My name is Faustine Chan. I'm the Business Innovation Manager for BBB, so I help coordinate these webinars that we've been hosting daily with different themes. Today's a very interesting theme. I'm sure a lot of you will have questions, so if you do, just please type them in the chat option or in the Q&A section. If you're really brave and you have a microphone and a camera, we can actually unmute you as well and also show video if you want to ask your question that way. So we have 2 great speakers. Today we have Jonathan Gallagher. He's co-founded Coastal Payroll in 2007 after spending over 6 years with national corporations such as ADP and Sallie Mae. After studying James Madison University, he moved to San Diego and has since been working to help making Coastal Payroll the most respected human capital management provider nationwide. We also have Shelley Addy. Shelley's a Penn State alumni with a BA in English and Writing and has over 27 years in senior human resources leadership experience and also 10 years in experience in corporate operations management. She helps employers build their HR infrastructures, navigate their employment relationships, and also protect themselves from pitfalls. And I do have to let you guys know, if we do get disconnected for some sort of reason, I just saw a message with Zoom that they're experiencing high levels of activity today. Just stay on the line, I will reconnect, so don't worry about that. But further ado, I'll go ahead and hand it over to Jonathan and Shelley.
Thank you so much, Faustine. Can you hear me okay?
Yes.
Awesome. Well, you know, before I introduce Shelley, I want to say I'm a proud board member of the BBB of the Pacific Southwest. I grew up with the Better Business Bureau in my blood. My father was the president of the Better Business Bureau of Central Virginia. So ever since I was young, I've realized how important it is, and I'm so proud to have the opportunity to speak and address questions with BBB accredited businesses. Now more than ever, it's critical that we draw a line in the sand and show where we stand, and that ethics is number one. There's going to be a tremendous amount of opportunity for fraud through these stimulus packages, and there's also a tremendous opportunity for mistakes as employers. And so it's critical that every employer understand these stimulus packages, how they impact you, and how you may be able to benefit from that. So Shelley and I have been giving town hall meetings and webinars almost every day for the last couple of weeks. And so our voices are a little dry, but we're going to try and get through this and help as much as possible. So I'd like to turn it over to our Chief Human Resource Officer, Shelley Addy, to kick it off, and then I'll take it the second half.
Thanks, Johnny, and hello to everyone. I'm so pleased to be able to be with you today, and I hope everyone is safe and well. So today we're going to talk about 2 laws that came into play last week and the week before. The first is the FFCRA, or the Families First Coronavirus Response Act, and then most recently on Friday, the CARES Act came into effect. So how do they impact your business? We want to be able to let you know that. So I'm going to go ahead and just review the agenda. I'm going to be talking about the FFCRA, and Jonathan will go ahead and take care of the CARES Act during his presentation. So the FFCRA basically is an emergency provision of paid sick leave and emergency family and medical leave. So let's talk about what those look like. First of all, generally for both of them, they go into effect on April 1st. So any of the benefits that are provided through these programs are not going to be retroactive. And they do say that there will actually be a grace period until 4/17 where the government will not enforce employers' obligations here. However, so goes into effect on 4/1, sunsets on 12/31. So these benefits are available beginning April 1st, ending the last day of this year. They are emergency paid sick leave, emergency or an extension of family and medical leave. And then also in the act, there was an unemployment stabilization provision, which we're not going to go into a lot of depth on because that has since even been added to by the CARES Act. So I'm going to leave that alone and just talk about EPSL and EFMLA. Now, for both programs, there are eligible reasons for use, right? And these two benefits programs are limited to the impact of COVID-19. So the reasons are as follows. The employee is subject to a federal, state, or local quarantine or isolation order. So here in California, for instance, Governor Newsom put everyone under an isolation order. If the employee is advised by a healthcare provider to self-quarantine, if the employee is experiencing symptoms and seeking a medical diagnosis, they are eligible. And notice that those three reasons are for personal illness. The next three, an employee caring for an individual who is subject to a quarantine or isolation order or has been advised, as in number 2, to self-quarantine by a healthcare provider. By the way, I starred individual because notably it's no longer required that that individual be a family member, by the way. Number 5, if an employee is caring for their child because the child's school or place of care is closed or the care provider is unavailable due to COVID-19, that is another reason. And then if an employee is experiencing any other substantially similar condition that is specified as coming under this act by the government, basically. So I'll explain the number 5 orange in a subsequent slide. Who are the covered employers? So for both EPSL and EFMLA, employers who have fewer than 500 employees are covered. Employers with 500 or more employees are not covered. So in determining whether you have fewer than 500 employees, you need to use the number of the employees that you have on the day that an employee requests leave, and that's how it is determined. You also want to make sure that you're counting all employees, full-time, part-time, employees on leave. Part-time, by the way, would also be interns, temporary employees who are jointly employed, and day laborers. It does not include independent contractors. So when you're counting your employees, you don't need to count them. All right, now you may have heard, and it does mention that there could be an exemption for an employer that has fewer than 50 employees. And we've wondered a lot over the past couple of days what that really meant because they didn't expand on it. Well, on Saturday, they expanded on it. So the one thing that is important for you to understand right off the bat is that this isn't a large or a blanket, let's say, exemption. It is an exemption per employee if the employee is requesting EPSL and EFMLA together. Okay, so let me explain. If you're an employer who has fewer than 50 employees and the leave is requested because of that reason number 5 that was in orange on slide 4, and if an authorized officer of your company can confirm the existence of at least one of 3 conditions, then you can be exempt. Now, let me give you these conditions in a nutshell. The first is that providing such leave would result in your expenses and financial obligations exceeding the available business revenues. that would cause you to cease operating at a minimal capacity. It's condition number 1. Or the absence of the particular employee who has requested the leave would entail a substantial risk to the financial, health, or operational capabilities based on that employee's or those employees' specific skills or responsibilities. Or condition number 3 is if there is not a sufficient enough amount of workers who can and are willing and qualified to replace the employees going out on leave. Any one of those 3 conditions, if you have fewer than 50 employees and the leave is requested because of EFMLA reason number 5, then you can be exempt. Unfortunately, they didn't talk about how to apply for the exemption. We're hoping that that'll come out in the next couple of days. All right. Now, for both EPSL and EFMLA, employers of healthcare providers may opt out. Who does that mean? It's anyone who's employed at a doctor's office, hospital, post-secondary educational institutions such as medical school, nursing school, local health department, et cetera, pharmacy, laboratory, and the facility can be a permanent or a temporary facility. In addition to that, any individual employed by any entity that contracts with any of those healthcare providers to maintain operations of the facility are also able to opt out. In addition to this, employers of first responders may opt out, and that includes any employee who provides transport, care, comfort, and/or nutrition, and any employee who is needed to limit the spread of COVID-19. So we're talking about military, National Guard, law enforcement, prison guards, 911 operators, that kind of thing. So, and also any individual employed by an entity that contracts with any of those operations to maintain their facilities is also able to opt out. All right, quickly, I'll get through this. For EPSL, there is no tenure required by the employee. So if they've worked with you since yesterday, of course, this is beginning April 1st, but if they worked with you for even 24 hours, they are eligible for the benefit. And what that benefit is for full-time employees who are battling personal illness or some form of it, quarantine, isolation order, they are entitled to 80 hours of EPSL at 100% of their regular rate of pay, as long as it doesn't exceed $511 a day. That's roughly $64 an hour. And the 80 hours, of course, is 10 days. So in aggregate, that would be 5,110. For employees who are caretaking and need EPSL for those purposes, they will be paid by the employer 80 hours of emergency paid sick leave at 2/3 of their regular rate of pay, not to exceed $200 a day. And that's roughly $25 an hour. So part-time employees are also included. They're to be paid based on the average number of hours normally worked over a 2-week period. All right, EFMLA, the eligible reason for use. There's actually only one. It's that number 5 on the list on slide 4. It's for when an employee has to care for their child under the age of 18 because school or child care provider or place of care is closed. This is presuming that they can't work or telework. Okay, so this is currently the only qualifying reason for emergency FMLA. The notice must be provided by the employee as soon as is practicable, and that you cannot withhold providing the leave while you're waiting for that notice, by the way. In addition to that, interestingly, EFMLA runs concurrently with conventional FMLA. So if you have an employee who needs EFMLA, if they have already taken FMLA under your policy, they will only be eligible for the remainder of the 12 weeks of FMLA in EFMLA. So for EFMLA, the employees have to have been working with you for at least 30 days. So 30 days tenure required. They are eligible for up to 12 weeks of leave. The first 10 days are unpaid, but the employee may opt to use any available paid time off, including EPSL. The remaining 10 weeks then are paid by you at 2/3 of the employee's regular rate of pay, and that's not to exceed $200 a day, again. In addition to this, the employee must be restored to the original position unless the employer has fewer than 25 employees and meets 4 requirements, which include that the position no longer exists due to the economic or operating conditions that affect employment, okay? Also, you need to have made reasonable efforts to restore the employee to the same or an equivalent position, making reasonable efforts to contact the employee, and you continue to make reasonable efforts for 1 year after. Okay, that is the end of my presentation.
All right, let me go ahead and yes, and I'm going to share here, share this, and let me start from here. All right, so I'm going to go over an act that was passed and signed into law by the president on Friday evening, known as the Coronavirus Aid, Relief, and Economic Security Act, also known as the CARES Act. It is kind of a monumental effort that we have never seen, I think, in modern history, with such tremendous opportunity for businesses to benefit from. And so I really think it's critical that anyone listening to this really understands how this can benefit your business. So let's go in and take a look at what this does. So there's a number of provisions in the CARES Act, but the one I really want to talk about today is a specific provision known as the Paycheck Protection Program, or PPP. Basically, there is a $350 billion program for small businesses available, loan program for small businesses. It provides an unsecured and basically, in many ways, forgivable loan to small businesses with the goal of keeping employees on the payroll, or employees that have been let go recently, hire them back on and pay them. The term period for this program is retroactive back from February 15th to the end of June of this year. It is 100% government guaranteed. It can be 100% forgivable if utilized for specific expenses, and we're going to go over that. So again, based off the loan, in many ways it acts like a grant. And it is retroactive back to February 15th. So if you're a restaurant or a hotel and you laid off a large number of employees, the goal is to allow you to rehire them with no penalty and to pay them, and that can be included in the forgivable nature of the program. So who can apply for this loan? Any business with less than 500 employees, or certain specific industries with less than 500 employees at one particular location. So there are particular industries such as restaurants or hotels that may have over 500 employees, but they've been so impacted by the COVID-19 crisis that based off of location, they could benefit from this. Most nonprofits with less than 500 employees, and basically available to all businesses that were eligible for an SBA loan prior to the COVID-19 crisis. So let's take a look at the details of the loan. Basically, as a business owner, you can access a loan that is the lesser amount of $10 million or 2.5 times your average monthly payroll expenses. And we're going to get into calculating that shortly. So again, the lesser amount, most people probably on the call will be looking at 2.5 times your average monthly payroll expenses. And we're going to calculate that together. The interest is capped at 4%, and payments can be deferred up to 6 to 12 months. There's no credit check, no personal guarantee, and the business must have been in business and paid employees prior to February 15th of 2020. So let's talk about the loan forgiveness component, and then we're going to go into how to calculate this. But the loan can be forgiven up to 100% of the full loan amount. And this is the items below count to how you can apply this towards the forgiveness of the loan. Your payroll costs immediately following the 8 weeks of the origination date. And when we say payroll costs, we're simply talking about gross wages. These can be wages paid to full-time employees, temporary employees, seasonal employees, but the goal is to look at how much you're spending in your payroll wages for the 8 weeks following the origination date. You can include mortgage interest on commercial properties for the business, provided that the mortgage was created prior to February 15th. So if you bought a building yesterday, you don't get to include the mortgage interest in this. But if you had the mortgage prior to February 15th, you can write off the mortgage interest for the 8 weeks following the origination of the loan. If you don't own the building and you rent, you can look at adding to the forgiveness of the loan the rent for the 8 weeks following the origination of the loan, provided that the lease was signed prior to February 15th of this year. And any utility payments during the 8 weeks following the loan origination. So internet, electricity, water, phone system, whatever utilities the businesses are utilizing. So you take a look at kind of going over this together, all of your gross wages that you've paid your employees for the 8 weeks following the loan origination, any mortgage interest or rent and utilities, all of that, you know, if that equals the full amount of the loan that you borrowed, you in essence will not have to repay this loan. If you cannot calculate or add into that, you know, everything that would equal the amount you've got. So let's say you took a loan for $100,000, and based off of these items below, over 8 weeks, you spend $80,000. Well, now you're left with $20,000 that need to be paid back. This is now goes into a 10-year term loan at no more than 4% interest with deferred payments for, you know, anywhere from 6 to 12 months. It's just a remarkable opportunity for employers with the goal of hiring back employees that you've either let go or to keep employees on the payroll so you don't have to lay them off. So let's take a look at how we calculate what your quote unquote payroll costs are and how much you could get for this loan. So the below amounts are based on criteria for the prior 12 months from the loan application. And basically they say, take a look at the 12 months of payroll prior to the loan origination. Well, that's kind of impossible because you have to figure out this prior to applying. So let's just take 12 months, your last 12 months of payroll information. What you would do is you would look at wages paid to employees over the last 12 months. And you would exclude, for anyone that made more than $100,000, simply the wages above the $100,000 mark. So if you have 12 employees and 10 were paid under $100,000 and 2 were paid $120,000, For those two that were paid $120,000, you'd only include $100,000 in the calculation. Any employer contributions to health insurance and any employer contributions to retirement plans. So wages paid over the last 12 months. And from what I understand and what we're hearing, you can even include 1099 contractors' wages if they act in a capacity similar to that of an employee, which is interesting. But any employer contributions to the health insurance and employer contributions to retirement plans. You take those figures, add them all together, divide it by 12, and those are your monthly payroll costs. You take your monthly payroll costs and you multiply that times 2.5, and that is your maximum loan amount that you're able to apply for. So it's really a remarkably unique program where you can, the goal of the CARES Act is to create a very large size loan available to employers very soon. We will be looking at, these loans will most likely be exercised through all banks. So lending institutions and banks. And I would say now is a really critical time for you to work closely with your banker and to work closely with your payroll company so that you can understand what your total monthly payroll costs are. And for anyone that has questions on this, we're happy to help. We put together an email address called help@coastalpayroll.com. We're glad to have a team member reach out to you and explain how these are calculated and how you could benefit from this loan. But again, right now, it's a great time to reach out to your banker and ask for the PPP loan information or the payroll protection program. So without further ado, that gives my high-level overview, and I think we knocked it out in about 30 minutes, Faustine.
So go ahead and type in your questions. I know that was a lot of information, probably new to a lot of us since we haven't been keeping up to date with everything. So just type in your questions, and Jonathan, you can go ahead and answer them as we get them along. So we do have a question from Robert. He writes, I'm very surprised that the EFMLA does not extend caregivers who have loved ones in senior care, skilled nursing, and assisted living facilities. Some of those facilities will be facing major disruptions and in some cases, far more than child care facilities in some instances. So do you think that Congress will make some adjustments to this reality at some point?
That's a great question, Robert. This is Shelley. We had that same question in our town hall meeting this morning. And, I do believe that Congress will have to make adjustments at some point. But I was as surprised as you, for sure.
We have a question, thank you, Shelley. We have a question from Ryan. Independent contractors being included, is this something new?
My assumption is that's in relation to the PPP loan, the Payroll Protection Program loan. If that is the case, then absolutely this is new. It's ironic because especially in California, independent contractors have been, employers have been so chastised for trying to pay people as independent contractors when they really want them to act like employees. Well, now in the calculation of this loan program, they're saying, hey, anybody that was an independent contractor that is acting like an employee, you can include them, you can include them in the calculation of your payroll costs.
He follow-ups and asks, is that a trap?
I don't believe so. Look, if you think about what's going on here, the federal government is evaluating the situation and saying, we've got a major catastrophe, national catastrophe on our hands. employers are shut down and are not able to pay employees, and therefore they're letting them go. So the best way to mitigate this is to infuse these companies with cash and incent them to pay their employees, so their employees don't go on payroll. They don't, they don't file for unemployment, and allow them to forgive the loan. So I don't believe in any way that it's intended to be a trap, and quite the opposite. It's just a remarkable almost bailout of small businesses that we've never seen.
So we have a question from Luke. I know some business owners rather do the layoffs. What is the argument against this? Do you think it will work what the government is incentivizing?
Well, you can either lay off or you can take advantage of the payroll protection program, right? If you lay employees off, one, you as the organization don't benefit other than you're not paying their wages. But if you lay them off, quite often you're going to have to pay out their PTO, vacation, whatever, any unpaid wages. In regards to the payroll protection program, the government is basically offering not only to pay your employees, but to pay your rent and your utilities. That is a remarkable opportunity. And any money that is left over that you weren't able to utilize in those eight weeks now becomes a very low cost loan that you could utilize for your business. So it's a really, I think it's a pretty terrific opportunity.
So we have a question from John. As the federal extended the unemployment by $600 per week, anyone who makes $6,000 a year will make less if stayed employed. If they refuse to be rehired, my payroll will be dropped. How would it affect my forgiveness part of the loan?
Well, it will impact the forgiveness part of the loan because you didn't pay those wages. Now, a couple things to think here. There's a number of employers that are saying, I am simply rehiring you and paying you, even if you can't do the work. Because there are many restaurants that are not allowed to be open right now. So they're just going to rehire them and pay them. And some are saying, well, that's not fair, or my employees don't want to work. I mean, I guess it's up to the employer there. However, if you're unable to forgive the loan, a portion of the loan, then you can simply pay it right back with no prepayment penalty. So there's really very, very little risk to you on it.
So we have another question from, Robert from the PPP. At what point in time is a loan reviewed for forgiveness? How many months or years out after origination, and is that the 8 weeks?
That is okay, Robert. Great question. The evaluation of the criteria for forgiveness are the immediate 8 weeks following the funding and origination of the loan. So now I assume there's going to be a period of substantiation after that, right? Where it's like, okay, in order to forgive this, I want you to submit payroll records. I want you to submit 941 quarterly returns. I want you to send in your utility bills, and I want you to send in a copy of your lease agreement, or at least a copy of a check to your landlord or your mortgage statement, whatever that may be. But really, the period of time for forgiveness is the 8 weeks immediately following the origination of the loan.
Great. So we have Trina, who asks, for employers who have already laid off employees, is it okay to verify we are approved for the loan before hiring those employees back? And I am also guessing there's a process to get the loan forgiveness after the 8 weeks.
Correct. So I think Trina and I just talked about the process of forgiving the loan, but I frankly think it's prudent to wait until the money's coming in, because there's so many employers that are down on cash flow right now. So I think what'll be really interesting to see over the coming weeks will be the communication coming from our bankers, right? So we're working closely with all of our bankers. And if you don't have a relationship with a banker, you should absolutely establish one now, who can help you obtain this loan, and then understand what the experience has been with from the time that I apply, how long did it take for me to get this loan funded. And they're talking about it trying to be one of the quickest funding experiences a business has ever encountered.
So we have Ryan asking, what is the fast track on getting the loan done, a certain bank or through the SBA?
It will be primarily through, from what we understand, now remember, this was all established Friday night, and every bank is trying to figure it out right now. I believe every bank is going to be funding this. You may be able to get it through the SBA as well, but what I'm hearing is that primarily most financial institutions and banks will be facilitating this loan.
We have Beth asking, she's in Arizona and we are not on shutdown. I have stores that are one-person employees. I have 2 employees that are no longer willing to work during this time, which has caused me to close those 2 other locations. I don't want to let these employees go, but they are choosing not to work. I want to pay them, but I also need to be fair to the other 2 employees who are working. How would you handle this situation?
Well, Beth, of course, you could take advantage of the PPP that Jonathan's been talking about. But you could also, I mean, I guess what you would need to do is temporarily lay them off and let them collect unemployment.
We have a question from Luke. Would you recommend any other types of funding if businesses get rejected? Maybe there are other options they can pursue.
The SBA does have an EIDL loan, which is known as an emergency, I forget, disaster loan of some capacity that can work hand in hand with the new PPP loan. I would think if there is any loan option that's the easiest to get, it will be the PPP loan. But there are a lot of options and grants right now available. I think your bankers will know what those are, with the intent of getting money in business owners' hands quickly so that we can pay our employees.
I think that's all the questions that we have on our thread right now. If anyone has other questions, please feel free to chat and type in the Q&A box and we can answer those. There's a question from Jenny. Jonathan and Shelley, I don't know which one you can answer, but they're wondering how they can reach their personal banker at this time, just because the phone lines are really busy. Is it email that they need to reach out to? What do you recommend?
Well, it's funny. I was telling my banker, you better not be working banker hours right now, right? I mean, this is when we need you working around the clock. So, yeah, I would just recommend email. Many bankers have their cell phone number on their email signature. Just tell them you need to speak with them in the next couple of days.
We have a follow-up question from Beth. If I laid them off, how would that work with their health insurance? And if I hired them back, do I have to pay them the amount they would have received up to June?
Shell? I think we lost Shelley here. If you laid them off, how would that work with their health insurance? Well, if you hired them back, you would not have to my knowledge.
I am back.
Okay, hi Shell. Did you hear the question?
I did hear it. I am so sorry. I couldn't get my cursor over the unmute button, so apologies, everyone. So if you laid them off, So a lot of it depends on, you know, if you're laying people off and you know a date that you're going to bring them back, you could certainly carry their health insurance. You know, otherwise you would want to, you know, let their health insurance run through whatever month it normally would, and then offer them COBRA. If you hired them back, you wouldn't have to pay them the amount that they would have received up to June.
We have Thomas. I own a tattoo shop. Which loan would be the best to stay afloat, as my artists are technically independent contractors?
Well, you know, Thomas, it's definitely a great question for your banker. My thought is that if you can substantiate and get the PPP loan and be able to confirm that you can write off and forgive rather those the loan amounts based off of what you paid your tattoo artist, that would seem like the best option for any business. It's such an unprecedented loan. In many ways, it sounds too good to be true, but that is the purpose of the loan. Is because we're in such a critical time in our economy that the government is saying we're going to bail a lot of people out. We're going to infuse cash into businesses, and we're going to incent them to pay that to their employees. And you know, it's really trying to keep the wheel of the economy greased and moving forward.
So we have a question from John. I just applied for the EIDL loan. How do I have to wait for the EIDL finished, or can I apply for the PPP now just to inform them that I have already applied for the other loan?
Yeah, and I would say you can absolutely apply for both. From what I understand, John, the EIDL loan cannot be used for the exact same purpose as the PPP loan. However, both could be utilized, and in many ways, I'm seeing CPAs recommend their clients apply for the EIDL loan, which is the economic disaster loan or emergency disaster loan, in conjunction with the PPP loan. There is even talk, and I got to look at justification on this, that you might be able to fold the EID loan into the terms of the PPP loan after the covered period has passed. So there's some interplay there between the two. You simply can't double dip and use both loans for the exact same reasons.
Thank you. Does anyone else have any questions out there? I know there's a lot of information just to dissolve and take in. We have a couple more minutes. We can take a couple more questions if you have any or think of any. Okay, well, I don't see any more questions. Thank you so much, Shelley and Jonathan, for taking time out of your busy day to educate us about this information. It's very useful, very time sensitive as well as for our business owners. I know we have a couple of call-ins, so if you did call in, you can actually go online to view this presentation as it's recorded as well. So it's on events.bbbcommunity.org. It'll be posted either tomorrow or the following day. If you have any questions, Shelley and Jonathan's help email address is on the screen as well. And the slides and the recording will be posted for you to view. But thank you again, both of you. Please stay safe, everyone.
Thank you so much.
Thank you, everyone. Stay safe.